We get started. My name is Jim Barrett. I'm the head of the institutional business here at Barron Capital. We want to welcome you to the next portfolio manager session. Thank you for being here, and certainly thank you for being clients of Barron Capital. We're going to do a brief introduction of the panel, and then we're going to go right to questions because this is your time. To my right, my immediate right, is Michael Barron, who's the co-portfolio manager of the Baron Partners Fund, and also co-portfolio manager of the Baron WealthBuilder Funds, which is actually a collection of all of Barron's. So if you want that type of investment to get into all of our strategies, that's a great approach. Further to my right is Andrew Peck, who is our co-chief investment officer. Has been with Barron many, many years. Also runs our mid-cap portfolios in the Barrett Asset Fund. And then all the way to my right is Neal Rosenberg, who happens to be the co-manager of the Baron Growth Fund. So at this point, I mean, this is your time. Why don't we get right into questions? We have someone, right?
It's a great way to kick off. Thank you. So Tesla has been a big position in the fund. It's currently around 45% of the overall assets. It's very important to remember we did not buy it at 45%. We bought it, I think the last purchase was in February of 2016. And at that point, it was on an 8 or 9% position. So the reason it's become such a large position in the portfolio is because, to be very frank, we were correct in our analysis. We are taking steps to manage the risk associated with that position size. We've sold around 25–30% of the overall position. We've also done things with leverage to bring down leverage. It actually increases the percentage of Tesla when you do that, but it lowers the risk in the portfolio. However, I also think it's very important to remember that today in 2022, Tesla is a very different company than it was back in 2016 when we made that last purchase. It's actually a lot less risky of a position now at this size than it was even at 8 or 9% position back then. Back then it was unproven. Now it is proven. It's a company that did 1 million cars last year, doing 1 million for this year. We think it can go around 2.5 million next year, maybe a little bit under, but 2.5 for round numbers. They're becoming more profitable. So they're doing more business, becoming more profitable, have many avenues of growth from here and into much steadier business than it even had been 6 years ago. So we feel comfortable at this size, but we are taking measures to manage the risk in the portfolio.
Yeah, just raise your hand if you have a question. We have one over here, but just keep your hand raised and we'll make sure we get a stagehand over to you.
Michael, can you talk about the non-public company positions in the Baron Partners Fund and how you envision the roadmap of the value of those investments being unleashed over the next 3 to 5 years?
Unfortunately, no. We have very strict NDAs prohibiting what we can say about our private holdings, unfortunately. What I can say is the level of diligence that we do on our private side is the same level of diligence that we do on our public side. So we go out, it's out there, SpaceX is a decently large holding in Baron Partners Fund. We go out there, we meet with them constantly out in California and more recently over in Texas. Understanding what their business is and what the prospects are. Valuation is outside of our control. We do not, a lot of funds out there just kind of market what they want to make up a value to be or what the last stated price was. The way we do valuation is it is outside the portfolio management. We have an outside risk team and risk and analytics team that determines it on a daily basis. So there is daily liquidity for our shareholders. Was any other part of the question that I can answer? Oh, in terms of liquidity, in terms of when it's going to go public? We probably envision this going public in the next, or there's a portion of the business going public in the next maybe 1.5 to 2 years. I'm not sure what I can say more than that, but that's our own estimate. Probably going to split off into 2 businesses, one being the launch business that will stay private and one being the communication business that will be public.
Would you please address what steps, if any, have been taken to curb the steep losses in the funds, especially those most concentrated in the NASDAQ exchange?
Andrew, do you want to take this?
Sure. I'm sorry, I just, with the echo, had trouble hearing the question.
Maybe you could repeat your question,
it?
sir.
Would you please be kind enough to address what steps or strategies you've employed that have been taken this year to curb the steep losses in the funds, especially those most concentrated in the NASDAQ exchange?
Sure. So, this has clearly been a difficult year in the equity markets, as we're all aware. Growth equities in particular have been hit hard by the combination, I think, of a variety of macroeconomic factors which are outside of the control of really any company, and particularly the companies we invest in. Rising inflation, which has led to rising interest rates, has led to a widespread reassessment of the valuations assigned to all stocks, but growth stocks in particular because of the long-dated nature of their profitability streams. With that being said, we feel particularly comfortable maintaining our portfolios in essentially the similar position as they were 9 months ago before this valuation reassessment occurred, largely because the sorts of companies that we own, broadly speaking, are high-quality growth companies that have pricing power, highly recurring and visible revenue streams, and cost structures that are both variable and are not disproportionately impacted by some of the factors that are most in the center of the inflationary increases that we're seeing in the economy, notably labor, commodity prices, et cetera. So as a result of all of that, although the valuations of many of our companies have corrected, of course, we feel even more confident in their long-term prospects and the opportunity today to purchase them at valuations that are frankly much more compelling than they were 6 and 9 months ago. So, to answer your question in a nutshell, the portfolio, speaking for Baron Asset Fund, but I think it's true of the portfolios that my colleagues up here manage as well, because we're long-term investors and because we own the types of companies that have the characteristics I just mentioned, you shouldn't expect our portfolios to be very different today than they were 3, 6, and 9 months ago. I'll leave it at that. Sure.
Growth in general is down because interest rates are up and the market is putting a bigger discount on future earnings. Are you guys changing your valuations since Barron is so focused more on the big picture long term, or are your valuations fairly consistent from where they were on January 1st of this year?
Sure. Do you want to?
Sure, yeah.
Why don't I let Neal answer that?
Sure, I'll begin and then invite everybody else to jump in. I think philosophically, when we think about valuations and setting price targets, we always focus on sort of 3 to 5 year time horizons. And when we apply multiples, we always apply or seek to apply what we believe is an appropriate sort of mid-cycle multiple, and seek to impute returns or generate returns to that sort of price target. I think when and again, going back through Baron Growth Fund and our historical experience, but I suspect it's the same for my colleagues here, we almost always underwrite, or we only make investments with the expectation that our returns will be achieved through compounded growth in the underlying cash flow or earnings or EBITDA stream. And very rarely, there are some exceptions, but very rarely do we assume or build an investment case with the necessity of achieving multiple expansion to meet our price target. When that happens, that's great and that's upside, but we never or almost never make an investment with that as the specific. So therefore, I think we're always, to answer your question specifically, clearly multiples have compressed. I don't think we've meaningfully needed to rethink the way that we assess the long-term price targets for the business, because we're not making these sort of short-term calls or building investment cases with this 3, 6, or 9 month time period.
The question over here.
So This question is for Baron Partners Fund regarding your SpaceX holding. Is there an opportunity to increase the holding further, or are you looking to increase the holding further? Because I look at it over the last several years, it's been the same amount of holding, so I'm assuming it's only the valuation that has gone up.
I'm sorry, the question is about how many holdings are in Baron Partners Fund?
So my question was regarding the SpaceX holding in the Baron Partners
SpaceX.
Fund, and are you looking to grow that holding?
We remain very, this is about SpaceX if we're going to buy more of it. SpaceX, it's a lumpy offering. They do an offering maybe every year, every other year. We have participated somewhat regularly in the past. It's hard to say, without giving it all away in terms of what we'll do in the future. But we do like the company. We do like the company at these prices.
Question here.
Can you address the overweight in Tesla? As a financial advisor, it's becoming difficult to recommend that fund. I know Morgan Stanley has downgraded it just based on risk. I know it's worked. I know you've made money, but the risk of having your top holding be 50% of the fund.
Right. I'm sorry, I think you might have come in a bit late. I really just addressed that at the first question, so I don't want to go into great depth again, but we can talk afterwards if you want.
Question. We have a bunch of questions in front. If we could get some microphones here. Maybe while we're doing that, Andrew, it might be appropriate, maybe just talk a little bit about what you're seeing in terms of your companies, our companies, in regards to fundamentals, in regards to guidance and earnings going forward versus what's happening in the market.
Sure. Well, I guess what I would say, sort of picking up on some of the remarks from earlier, I mean, broadly speaking, we're investing in businesses that we think have long-term secular growth opportunities. And one implication of that is that these businesses, generally speaking, are much less susceptible to changes in the broader macroeconomy, the impacts of inflation, higher interest rates, a slowing economy, et cetera. So as a result of all of that, I would say, generally speaking, the positions in my fund, particularly the larger positions, those that have the greatest weighting, have, by and large, reported earnings, like in the case of Gartner, which is an IT research services firm, which is the largest position in Baron Asset Fund, is a significant position, I think, in both Baron Partners and Baron Growth Fund as well. Just 2 days ago, they reported earnings and actually raised their guidance for the fourth quarter of this year and raised the expectations for what they're likely to report in 2023 as well. And the reason for that, without getting too much into the weeds of Gartner in particular, is the fact that it is a business that meets all of the criteria I tried to lay out a moment ago. It's a business that has strong competitive differentiation from others in its space. It has pricing power, meaning that in light of the difficult inflationary environment, they've been able to offset virtually all of the inflationary pressures they're feeling from their suppliers and cost base by increasing the cost of services that they're selling to their customers. In addition, they have a highly visible and recurring revenue stream in that they're selling largely subscription-based products. So even as the economy has become more uncertain over the last 3, 6, 9 months, most of their contracts have been locked in for a period of years and so are relatively unimpacted by sort of broader headline risk. And then lastly, from a cost perspective, they don't have outsized exposure to things like energy, commodity, food prices, many of the things that are causing the inflation rate to read at the levels that it does. So as a result of all of that, despite all the terrible headlines we're constantly bombarded with, Gartner is a company that actually increased its earnings guidance for this year, I think roughly 12% just a couple of days ago. So there is an opportunity, even in difficult, challenging markets like this, I think, to find competitively differentiated companies that are able to withstand the macro headwinds and execute well and hopefully be rewarded in the marketplace as a result.
I know we have some questions up front.
Michael, sorry to bombard you with this, but first of all, congratulations to you and your dad for recognizing Tesla many years ago and riding it to the top. You've made me a lot of money, and thank you.
Well, thank you.
But the reality is, right
We don't often
now,
hear that. We often hear the other side of it, like, well, why do you still own this thing?
but we
But
both know,
But the other side.
Now the hard one.
but we both know the catalyst of Tesla has been Musk, no question about it. Now Musk is embroiled in a real awful situation with Twitter, and it seems to be taking up a lot of his time, and it's probably going to turn ugly before he turns it around. Are you afraid that that's going to take his focus away from Tesla? And are you convinced that Tesla's got a good enough of a backbench that you're not that concerned? Thank you.
Sure. No, I think that's a very valid question, a good question. Look, we were actually just joking backstage. First of all these questions, whether it be about Tesla, Twitter, SpaceX, we're under an NDA with some of these companies. To give a little bit of a hint, maybe in about an hour or so, someone's going to be on the main stage who's not under an NDA, who might be able to address some of these questions in better depth.
Who's that, Michael?
I wonder. Look, we were joking backstage in terms of, I was saying I have, one job, one wife, one kid, and I'm exhausted all the time. I don't understand how Elon does this. But when we go and see these companies, we obviously speak with him and understand his vision, but he's done an incredible job in terms of surrounding him with incredible executives, talented executives, engineers, and there's always a headline that comes around, especially with Tesla, so-and-so just left the company, and the stock maybe sells off, people get a little nervous. There are so many people right behind that person. It's not one person that can build an entire company, whether it be Tesla, whether it be SpaceX, whether it be turning around Twitter. And we meet with him. We get out there and we actually, we don't just read news articles about what he's doing. We actually go and interview him and interview his team around him. We feel very confident that he's assembled the right group to, no pun intended, drive Tesla forward. So I'll leave it there in terms of.
It's an 8-minute moratorium on Tesla questions. We have one right behind you, sir.
Gentlemen, can you hear me? Hello?
We can hear you.
Yeah. I'd love to hear from each one of you. What's something you've changed your mind about this year? Like completely seen it a different way than you did on January 1st?
Just start us out, Neal. We'll work our way left.
Pardon me?
Why don't you go ahead, Neal?
That's a very broad. That's a very broad-based. That's a very broad.
Glad you went
I
first.
assume you mean about the portfolio or the market, not about life. What? Yeah, you don't know my life. It's probably not true. So I would say, what is different? No, I think one of the things that we have, I would say one of the things that has proven out to be, extreme, that we always hypothesized and recognized, I think, in years before this, but really gained, gained incremental conviction in, was the view that sort of inflation is incipient and perpetual and pervasive in the economy. And I think there's been, for several years, we've printed effectively the headline numbers have printed effectively no inflation. And that hasn't really been consistent with the way, my own life and my own experience and the businesses that we've invested in have articulated sort of the end market trends. Now you've seen, sort of a significant swing or a significant escalate or elevation in that number. And I'm not sure it's really 8 or 9 or 10% in aggregate. But what has, I think what we've gained more conviction in, rather than changing my mind, but I think becoming more convinced in, is the importance of investing in businesses that are able to recognize pricing power and pass through that pricing at a rate that is equal to or greater than sort of their aggregate growth of costs. Andrew mentioned this before, and he mentioned, he mentioned Gartner. I think historically Gartner, because of the stickiness of its business and the value out of its product, has raised prices 3% or so on average, and this year they're raising it 5%, and their cost base on a same-store basis is growing 4%. Similarly, just across the Baron Growth Fund portfolio, in other sectors, Gartner is a syndicated research provider. IDEX Laboratories, a veterinary services provider, has always raised prices 2%. This year they're raising prices 6%. In financial services, which I think Josh Saltman just previously spoke about, FactSet, a large position, raised prices 2.5%. This year is recognizing 5% price increases. And then, maybe in consumer discretionary, Vail Resorts historically has raised prices 4 or 5%, and I'm sure Kirsten will speak about this on stage, is raising prices 7.5% this year. All of which are sort of, we've all had, we've sort of they've always had this theoretical pricing power, and it's been, I think, gratifying and maybe a relief and also conviction building to see them exercise that pricing power to a greater extent this year. So maybe something that I've changed my mind about, maybe recognizing the importance of, even if it wasn't necessarily a 180, I think it was, incremental conviction about the necessity to own businesses that can appropriately pass through pricing that's equal to or greater than their cost inflation.
Yeah, I'd say quickly, one of the things that I've changed my mind about / been most surprised about, as it relates to the equity markets, is that over an extended period of time, high-quality growth stocks have outperformed every other broad-based sector within the equity market. And historically, in difficult and uncertain macroeconomic markets like we're experiencing today, high-quality growth stocks tend to outperform, at least on a relative basis, the broader stock market. This year has been the opposite of that. Value stocks, energy stocks, commodity-related stocks have led the market, and high-quality growth stocks, for the most part, have trailed the market in some cases by significant amounts. So I've been surprised by that. I think other market pundits probably have been as well, but I think that provides an obvious opportunity looking out over an extended period of time, because the reason high-quality growth stocks have outperformed over 10, 20, 30-year period is that those are the sorts of businesses that are best positioned to grow the fastest, to achieve the largest market caps over time. And so I am cautiously optimistic that within a reasonable period of time, particularly when some of the concerns about if and when interest rate increases are going to stop and the interest rate environment becomes somewhat more normalized, wherever that ultimately ends up, that high-quality growth stocks will again be the leaders in the market as they traditionally have in difficult environments like this.
The next one.
Okay. We have some questions up front.
Hello.
Where are we? Oh, there we are. Okay.
I initiated a position in FIGS in June, and was thrilled to see you initiate your position in August. I got in around down 40%. You guys got in down 55%. Stock's now down 75%. I still love it. What goes into your decision-making about adding to that position? Do you simply dollar cost average? Are you looking for targets? I don't know who's selling this stock, but could you speak a little bit about that newest holding?
Yeah, I can take that. So we did report at the end of September that we have a small position in Baron Growth Fund in FIGS. I think your question is specifically just about managing managing position and and adding or electing to sell it. I think there's a litany of factors that can that can go into that decision. But I think what we're always looking to do, not just with FIGS, but with business, with all businesses in which we are invested in, is to test and retest our thesis and make sure that we have a compelling and differentiated and sustainable view on what the ultimate growth rate can be, what the ultimate earning stream can be, and what the ultimate cash flow stream can be, and maybe to our and so I think what we've been focused on doing has been to try to test and retest and iterate around that thesis. I I think there have been multiple reasons why the stock has come down, but more than anything, maybe getting back to some of the topics that we've touched on before, it's been a combination of decelerating growth as a result of challenging comps challenging comps that were built through the pandemic. That is something that you've seen in many online or e-commerce only direct-to-consumer businesses. As one, there were challenging comps, but two, some of the growth trends that were accelerated during the pandemic has reversed. We view that as a short-term phenomenon, and again, as we do research and iterate, we find that we continue to have sort of compelling conviction around the business that a business that's doing $500 million or so in revenue today, growing to about $1 billion over the next 3 or 4 years. The other side of that is, of course, the multiple, and we've talked a lot about multiple compression here, and as importantly, the way that we endeavor to apply what we believe are fair mid-cycle multiples to the ultimate earnings or cash flow stream of a business in order to create what we believe is an appropriately underwritten risk-adjusted return. We continue to have conviction in that, and from our perspective, to the extent that the stock continues to decline, and we continue to have conviction in what the ultimate opportunity will be, the effective risk-adjusted return is increasing, and it sort of increasingly makes us want to potentially add to that position. I think with respect to Baron Growth Fund specifically, one lesson that we have learned over the past 5 or 10 years is that we do take small initial position sizes in order to be nimble and in order to recognize that multiples are fluid, one, and two, our conviction tends to increase in one way or the other with the more work that we can do and the more time that we own a stock. So our initial position in FIGS is representative of our initial position in most new stocks at 25 or 30 basis points, which leaves us sort of the flexibility to pursue any of the avenues that you're alluding to in your question.
Some question up front here. You've been having your hand up for a while, sir, so.
For Michael, the WealthBuilder Fund is a fund of funds. How do you decide how to allocate money between the underlying funds?
It's a great question, and maybe my favorite topic. So we started Baron WealthBuilder just about 5 years ago, just under 5 years ago. It's 5 years ago in December. It is, I don't like to call it a fund of funds, to be honest. Technically it is, but fund of funds has a negative connotation. It implies fees on top of fees. What we've done from day one is be very clear we are not going to do that. We are not charging an overlay fee to the underlying fund. So it's just purely paying the fees of the underlying funds. It's been around 5 years. It's been the #1 performing fund in its category over those 5 years. How do we decide what we're going to invest in? It's a very tricky thing to try to explain. It's not formulaic based. Other people want to understand the formula. There's not a formula. It's getting a lot of information, a lot of data from our risk and analytics department, understanding what the portfolios look like, where we're seeing growth in different portfolios, and how these other portfolios complement each other, where are there overlaps, where the not disagreements, but where the portfolio is diverging, and constructing a portfolio accordingly. We have had a bias towards small and mid-cap U.S. investing. That's the heritage of this firm. That's because we find the most opportunity there. That's where it's most inappropriately valued. And we feel that's going to continue to be the case. Around 2/3 of the portfolio is in small and mid-cap investing. You can expect that to be the case. Maybe 10 to 15% is international. And other than that, I can go into some more detail if you want. We can talk later, but it's a lot of data from our risk and analytics department trying to understand what the optimal portfolio is, but not formulaically based.
Time for one more quick question. Yes.
Hello. So you guys have gotten many things right over many years, so thanks for that. But my question is more specific to one thing that you got wrong. And what did you get wrong about Zillow?
I mean, okay, I'll. I guess, in the interest of time, what I'd say is the following. Zillow is a company that's run by a guy named Rich Barton, who we've known for a very long time and who we think of very highly. His initial base business was one that was centered around sort of transforming the way homes are marketed from offline advertising channels, such as newspapers, into online marketing channels, such as the Zillow website, and Truly and a number of other brands that they own. I think one of the errors that he made, frankly, was during a time a year and a half ago when the housing market had remained very hot and frothy, decided to sort of extend his business model into one that was predicated upon being able to buy and sell homes in the same way that a variety of other types of merchandise have been transformed through e-commerce and have been transformed into much more liquid markets, such as used cars, et cetera. It proved to be an incorrect strategy, one that we initially bought into, both based on our research, but also partly because of our faith and confidence in Rich. So I think that was part of, certainly a big part of our mistake. And I think secondly, and somewhat related, the business has proved to be more exposed to cyclicality in the home market, the housing market, than we had anticipated. And I think it was the combination of those two factors has led Zillow to be a very challenging stock. I would say that fortunately, although it wasn't our greatest investment, it was an investment that we made money in. We sold the stock probably close to a year ago at this point. I think at sort of the $50, $60 level, the stock's now 30, so it was 50 or 60, down from a much higher level, but nevertheless, we feel good about the fact that we avoided a further 50% drop in the shares. But it was a learning lesson and very fair question to point out.
So our time is up for this particular session. These guys will be around if you have some further questions, certainly related to your financial advisors. Yes, they deserve a hand. And thanks again for your time and your confidence in Barron.